Chat with Traders, episode 102.
This is your key to the minds of trading's elite performers, those who profit in relentless markets. Here on the Chat with Traders podcast, you'll hear about the skill sets and tactics that lead winning traders to win, so you can level up and become a better trader. Here's your host, Aaron Fifield.
What's going on, fam? Episode 102, and I have something a bit different for you this week. Here's the rundown. My guest is Eugene Soltes. Eugene is a finance professor at Harvard Business School, and over the past 8 years, give or take, he's gotten to know and spent a lot of time with many big-time executives and professionals who have been convicted of major financial crimes, such as cooking the books, fraud, Ponzi schemes, and even insider trading. What began as nothing other than self-interest has escalated into a 464-page book, which was released in October this year, 2016. The book is titled Why They Do It: Inside the Mind of the White-Collar Criminal. Intrigued by the subject matter, I invited Eugene onto the podcast, and we got talking about how Bernie Madoff became the mastermind behind the biggest fraudulent scheme in US history, sucking billions upon billions of dollars from unsuspecting investors, some of the notorious insider trading cases, and ultimately why they do it. As I mentioned, Eugene's book is available now, so if you'd like to take a closer look or even grab a hardcover copy, just go to chatwithTraders.com/why they do it, and that'll take you directly to Why They Do It on Amazon. But also worth mentioning, you can get this as a free audiobook too when you sign up for a free Audible trial, all at the same link, chatwithtraders.com/why they do it. Okay, folks, here it is, my interview with Eugene Soltes from Harvard Business School in Boston. How's things? What's been going on?
Things have been well. I actually just been doing a pile of presentations on the book. So I actually just arrived back. I was doing one at another university. A couple of schools are actually giving it as I guess reading in some of the finance classes, and I guess it's both easier and I think probably a little bit more lively if I give a presentation than the professor. But given how many schools there are in Boston, I've now done this 5 times. So.
So you're getting to know it pretty well.
Yeah, at this point, I don't know backwards and forwards quite yet, but I think probably a couple more iterations I'll get there.
You're getting there. Nice. Oh, that's cool, man. It's good that there's a lot of interest around it. Very cool. My copy arrived in the mail just the other day. Obviously, I haven't really had a chance to read too much of it, but it's definitely something I will be reading for sure.
Oh, good. Well, there seems to be it's certainly a different take on some of the, I guess, white-collar crime compared to some other books written on the topic. So at least it spurred some different conversation, which seems to be well-received so far.
So I wanted to bring you onto the podcast because I'm really intrigued by this book you've written, which is titled Why They Do It. But before we talk about that, let's hear a little bit about yourself. So, besides now wearing the badge as an author, what else do you do?
Well, my main job is I'm a professor at Harvard Business School. And in this role, I teach a number of our executive education programs, primarily in finance, accounting, and some of these, gray area decisions like those described in the book. And most of my empirical work, this is a qualitative work we're talking about, the book, but most of my empirical work looks at issues around financial economics and corporate disclosure.
Okay. And is it true that you had aspirations of becoming a trader yourself before you went down this path?
I did. Actually, in many ways, this is what I expected to maybe hopefully do an interview with you, but in a different context, had I taken a different path. So I actually spent my background in college. I was in economics, and I did a master's in statistics. So very much thought I was going to be a kind of a quantitative finance guy. Spent some time at UBS trading options, exotic options, and but then I ended up going to get a PhD, and then the financial crisis hit, and I found myself looking at different prospects, and was offered a position at Harvard Business School, and had a couple other offers, and thought that would be something interesting to try. Very much, I didn't know if I would ever be truly meant to be an academic, but it turned out it suits me very well, because ultimately I get to explore the same kinds of questions that I'm interested in the financial world, but I get a lot more time to delve into them much more deeply. So it's been a lot of fun.
Right. Okay. And how long have you been doing this for now?
So this is I've been on the faculty of Harvard Business School for eight years. And this book, kind of strangely enough, actually has been continuing that entire time. It actually originally even began as I was a graduate student. So this project is very much one that's my entire life as a scholar.
Let's talk about the book. Like, what motivated you to write this book? What sparked the idea for it?
Well, it started out not as a scholarly project or intellectual endeavor. It started out very much as, I'll say, a question of a personal interest, the same that I think many people have. So actually, as a graduate student, when I was actually finishing up my dissertation, a big empirical data set looking at how dissemination by the media affects the volatility and cost of capital for firm shares. So a very kind of traditional asset pricing type project. I'm up at 3 a.m. watching TV, desperately trying to stay awake while I wait for some regressions to come out. And I came across a show on MSNBC called Lockup. And it's a great kind of show to watch at 3 a.m. That's a cross between a reality TV show and a documentary. And they go into prisons and basically interview people to understand what happened. And most of the people on the show are violent offenders, murder, assault, rape, things of that nature. And I'm watching this show and thinking about the people that are kind of closer to my heart, which is, as a financial economist, I'm thinking about all these business leaders, people that I, like others, looked up to, people that were on the cover of Fortune, or on CNBC talking, the titans of industry. And I was watching the show and just wondering, if they were in this position, what would they say to some of these questions? These are the people that we hear so much about. We read, we hear from them when they're successful, but all of a sudden when they've made some errors and are sent away to prison, they disappear and we never hear from them again. And so that evening, out of just personal interest, I sent some letters to a couple of the people from Enron and Tyco, that came to my mind that were very much still in the news at the time, 8 years ago. And went back to my dissertation work. And then a couple months later, I start getting letters back from people. Some started responding to my questions. Others, like the CEO of Tyco, Des Kozłowski, said, sure, I have time now. Come visit me and we can chat. And it's actually just from that really just personal curiosity of trying to understand what's happening here that this project was created.
So what sort of things were you saying to them in the letters?
Really, I think open mind and curiosity. So I would start saying, I'm, as I joined the faculty and I was writing people, I'm a faculty member at HBS. I'm a financial economist at heart. I've looked at your career and, you did a lot of amazing things, impressive things. But simultaneously, I'm also trying to understand what happened. How did you end up in the position you're currently in? And could you spend some time and could we kind of just walk through things? And I'd like to better understand your perspective. I think one of the things that probably made that helped me create these conversations and kind of spurred interest on the part of people I was writing, people who were in some cases uncomfortable talking originally or haven't spoken to people in the media, is that I did commit. And the nice part, being an academic, I didn't need to just have one conversation like a journalist and then have to write an article at the end of the week. I could commit that I would spend as much time as I needed to really try to understand their perspective, whether that was days, weeks, months, in some cases a couple years with some people, before I really felt I was understanding their perspective, because that's ultimately what the goal of this project was, is to put myself in their shoes and try to see the world as they saw it, and convey that to my students and ultimately people that read the book.
So when you initially sent letters to these people who you've documented in your book now, did you actually have intentions of writing a book at that time, or was it still just general curiosity?
No, this definitely didn't start as a book. If anything, quite I think had I realized how much time and effort that I would ultimately spend this project, I might have run the other direction. It started as, I mean, genuinely just as curiosity. I thought I was just going to have some conversations because it would just make me a more informed person. Frankly, I still do this now in a variety of other contexts. When I'm trying to learn about a new industry, I write leading people in industry and want to sit down and learn from them. And the same thing, if we want to understand successful people that have ended up making some mistakes, oftentimes quite significant mistakes, I think we need to spend time and speak to those individuals in the same manner. And then what kind of got the ball rolling is that one of the initial letters I received back was from Stephen Richards, who is the global head of sales of Computer Associates, an Australian, actually originally before he moved to the United States. And in this really articulate and I think thoughtful and reflective letter, he described some of the pressures and challenges that he faced. And I took this letter with Stephen's permission and actually wrote a Harvard Business School case around it. Basically, just literally reprinted his letter and then wrote the context behind what was going on at Computer Associates. A really kind of, I could say, subtle fraud in that they didn't make up anything, but rather they had contracts that came in on Monday and Tuesday, and they backdated them to the following Friday to make them go in the prior quarter. So a pretty, you could say, different from some of the more, larger and egregious frauds. But ultimately, because of this backdating for a few days, 8 senior executives went to prison for quite lengthy sentences. And so I took this letter that Stephen wrote. I wrote this case, and we taught it as the last class in the MBA curriculum at HBS. And students and my colleagues had a lot of interesting things to say after the hour and a half discussion with ultimately 900 students read this case the first pass through. And it's still today. I mean, what's interesting from this one case, this is now still taught to everyone that comes through HBS. It's taught at the end of the first semester for all the MBA students. And then it's taught in many of our executive programs, and it's taught it now around 60 other business schools around the world. So this really thoughtful letter is kind of it after actually hearing the discussion and questions that students and colleagues would ask me after doing this case discussion, did I realize there might be something really here more substantive than just a kind of personal curiosity, that learning from these executives' perspective, we might gain a deeper appreciation for some of the challenges and mistakes that they faced and made. So this is where I started delving more deeply into both the background about what might be going on, the psychology, the sociology, the different literatures that could explain this. And then simultaneously, I really started speaking to many more people to get their perspective.
Right. So it's evident that some people were responding to your letters, but, generally speaking, how willing were they to speak with you, or was there some hesitation? Because I imagine that most of them probably weren't overly proud of where they've ended up.
Yeah, I think this is one of the, I'd say 90+% of the individuals I wrote ultimately ended up speaking to me. There was 2 or 3 cases where people still had ongoing litigation, and for that reason, they didn't feel comfortable talking. I'll say in some cases, even people with ongoing litigation were still willing to chat. And there were 2 or 3 other people that were just simply, I think this was just such an overwhelming experience for them that they just literally couldn't bring themselves to speak about it. But by and large, people were willing. What I learned is that no one was, except for a couple unusual exceptions, no one wrote back that they were excited to talk about this. What they would write back is saying, this was challenging, but I think I see that there's an educational benefit for helping, students. Some of these people are graduates of Harvard Business School and Wharton and some of the top business schools. And so they do feel that there's things that they can share, both with the mistakes they made, but they also think, and I agree with them, that there are things that they could share about some of the better things they did in their career. So in most cases, when I would start talking with people, we wouldn't jump in and talk about the challenging parts in their life. What we do is spend many conversations, oftentimes, talking about how they got from college or even out of high school. How did they go from those modest beginnings to becoming a corporate superstar? So talk about the things in life that were actually really successful, that not only serve to help me understand their background, where they came from, and some of their actually quite innovative things they may have done that were entirely appropriate, but it also helped build a relationship that we were able to then understand one another and actually kind of delve more deeply into various things.
And one of the people who I believe you spent the most time with in creating this book was Bernie Madoff, probably also the most publicized character. For those who may be unfamiliar, bring us up to speed with who is Bernie Madoff and what is he infamous for?
Yeah, so Bernie Madoff is will go down, at least I think in the history and certainly for quite a bit, is the mastermind of the largest Ponzi scheme in history, in on the order of $20 billion in terms of, you could say misappropriated assets. Now, what's fascinating about Madoff's career, though, is that he actually began in the 1960s is kind of coming from a fairly middle class, nothing from an extraordinary background, but kind of started with these off exchange, over the counter securities. He came up kind of from nothing, so to speak, and from this built a brokerage firm that actually was extraordinarily innovative in bringing in electronic trading, things that we take for granted today. Many of those innovations were led by his firm, and then later the NASDAQ, which he became chairman of. He also was one of the pioneers of paying for order flow to help divert order flow from the main exchanges to other exchanges, something that we also now take for granted, that there's a lot of different exchanges where people can competitively trade securities. His firm also helped lead the practice of decimalization, of actually bringing down spreads, something that every trader can appreciate, of not having these extraordinarily wide spreads just by definition in every security. So his firm paved the way in a number of these regards. At one point, I believe it was in the 1980s, his firm traded actually 10% of all NYSE listed stocks off the exchange. Just an extraordinary volume. And so against this background of building a really quite remarkable brokerage firm, Madoff also created a investment management business, and a kind of, you could say, it started as a side venture alongside this brokerage business, but ultimately grew to become this rather extraordinarily large fund in the tens and tens of billions of dollars that would ultimately become the heart of the Ponzi scheme. And it's for that we now, I think, remember and think about Madoff. And one of the things that makes him different from any of the executives I spoke with, but then you could say any executives that have been convicted, is not only the size of his fraud. We're talking, if we go the second and third largest, looking at like Alan Stanford, we're talking there $5 billion type dollars. Madoff's is quadruple that. So we're talking a huge magnitude. But simultaneously, Madoff's victims were also people that in many cases he knew. These were family. These were friends. These were individuals that were close within the Jewish community. And that's what makes his fraud pretty exceptional, is that these are not distant, abstract victims, like when we think of insider trading, people that you can't even really identify. These were close, intimate contacts. And I think it's unraveling how he could do that to people that were trusted him, that were so close to him, that really has created so much, I think, fascination and just kind of horror about what he did.
So what exactly did he do wrong? Like, how does a Ponzi scheme work?
Yeah, so the basis of a Ponzi scheme is it's misappropriating assets. So, I mean, in his case, how it would be billed and how he described it would be quite this mundane description at first is a, quote, books and records violation. But essentially it starts with the fact that he was trading for securities. Specifically, you could say he likes to think of it as he was naked shorting a strategy to clients, but ultimately not repurchasing those shares, and ultimately had a capital violation. In that regard, it's not something you could say that exceptional. That's a regulatory violation to the extent that you have more securities. Basically, you're over levered, but you don't have a sufficient amount of capital. That's a violation, but that's something that many institutions run into. Now, what firms normally do in that case is you then get your capital under control. You do something to fix that problem. You raise more capital. Let's say you get out of that. Now, in Bernie Madoff's case, what he did is, in some sense, he continued kind of doubling down. And the problem is you do that and you keep having more losses. He basically was trying to tout and sell a strategy to people that ultimately wasn't successful. This notion of something he called the split strike conversion. It's kind of an option arbitrage based strategy. And he ultimately wasn't able to trade that profitably. Now, ultimately, it seems like he was doing some trading for clients throughout the 80s and in even the early 90s. Not completely, but doing some. But ultimately, by the late 1990s, he wasn't trading at all. And this is when it became a true Ponzi scheme, is that ultimately money was coming in the door. So $100 would come in the door, and then ultimately he was paying out 50 of that to investors the following day to satisfy redemptions or other money going out the door. Where it's literally you're taking in money and immediately paying it out to someone else. There's actually no underlying business going on. And that's ultimately, by the 90s, what his business became, which is rather remarkable in that for at least a decade, and potentially quite a bit longer, there was no actually substantive actual business at this investment management firm he was running, despite the fact that it was probably one of the largest. We're talking, there's been various estimates. We're talking $50 billion plus in terms of money, money under management, which would place it in the leagues of even some of the largest hedge funds today. But ultimately, he wasn't doing anything with it.
So that last part where you said he had taken $100 and then pay out $50 to investors, are those investors who are invested with him, or is that someone else? Like, how does that part work? I don't quite understand that bit.
Oh yeah. So this is actually investing for him. So he has this group of investors that he had hundreds of people directly through him, far more even through some of the feeder funds that were giving him money, and they were as additional investors were paying money into his funds. And one of the things about Madoff is people were kind of jumping kind of head over heels again over one another to try to give him more money. So and he would always be saying, actually, I'm not going to take more now. I can't take more money now. But then ultimately, some people he did let invest. And so ultimately, this money that came into this fund would be sitting in this pot, so to speak. And then there would be redemptions. He was creating statements that were going out to people on a monthly and quarterly basis, describing rates of return. We're talking, 8 to 12% in a lot of instances. And then there would be redemptions. And the question is, well, where'd the money from redemptions come? Well, the money ought to have come that if you were invested in this fund, it should have been kind of that pot that was designated in some sense to you, that was actually being invested in the securities that were described on the statement that you were receiving. Turns out in his case, actually, that pot, so to speak, not really a pot. It literally, when someone wanted a redemption of $15 million, he was looking around for $15 million of proceeds that were coming in to pay that money off that was coming in redemptions. Ultimately, what ends a Ponzi scheme is the fact that when the amount of redemptions exceeds the amount of money flowing into the fund. And that's what he ran into, when we talked to 2008, he starts confronting.
So when you say redemptions, you're talking about when investors want to take their money out of his fund.
Exactly. And this could be for their own liquidity reasons, to the extent that very few people were removing money because the returns were not adequate, because they were fantastic. If you actually look at a graph, any of us would jump into that. It's kind of like, it would be like the equivalent today if we could invest in treasury bills at 9%. That would be fantastic. But in some sense, also, you could say too good to be true. And one of the major accusations and also a delicate area, which there's been much discussion about whether some of the more sophisticated investors in some sense look the other way or even reckless in not recognizing that, they were getting for decades these kind of consistent, 8 to 10% returns, which, as has been shown, was totally infeasible with the strategy that he was touting, that he was actually trading in and selling to people.
Right. Okay. So the returns looked really good on paper, but in reality, those the money actually wasn't even there. Is that correct?
Yeah, the money wasn't there. I mean, he would actually produce a statement, and I actually got one of these statements from eBay recently. But the statement would show a list of the various essentially calls and put options that he purchased, and then this underlying basket of S&P shares. But what if you actually look at so on the statement, it describes exactly the calls and puts that lead to the particular rate of return that investors expected to receive, the 8.6% they thought that they received that month. Turns out, though, this statement simply reflected a after the fact creation of some securities that led to that output. He actually never invested in any of those call options, any of those put options. In fact, if you actually look at the amount of money, the tens of billions of dollars he had invested, it was not actually even feasible for him to be running the strategy because he simply had too much money to actually, he would have overwhelmed those various markets.
So how did he benefit from running this Ponzi scheme?
Well, I mean, that's an interesting question to ask now, given he's serving a 110-year prison sentence for it. But I'll say, you could say at the time, he was one of the most respected individuals in the securities markets. This was a guy that had kind of the creme de la creme of investors wanting to give him more money. He was the leader. He had leadership positions in many of the most prestigious organizations. For example, the chairman of the NASDAQ. He was someone that regulators called. When the SEC wanted to talk about the changes that they were going to be making to the securities market, you would pick up the phone, you'd call the major banks, you'd be calling Goldman Sachs, you'd call Merrill, you'd also call Bernie Madoff. So he was a well-respected, admired leader in the securities industry. So that's one. Two, he also was very, very well paid. Even by the 80s, he was acknowledged as one of the higher paid people on Wall Street. In large part, it seems like at that point, actually, from his brokerage business. But obviously, to the extent that he was taking in billions of dollars to his investment management business, even taking a small spread, which is a question that people often ask, is hedge funds today charge, the common is still 2 and 20%, so 2% fees off of assets under management and then 20% of profits. Bernie Madoff didn't do that. He basically was kind of like running a hedge fund, but in some sense of charging 2 and 20, he said, all I want to be paid for is for the trades that I do. In some sense, trading commissions. And that always struck people is, on one hand, people thought that he's just this generous guy, that he was doing so well that he didn't need to make more. He didn't need to take 2 and 20 and make, hundreds of millions of dollars a year. He'd be happy with, the modest, quote, millions of dollars a year that he would make from the trading commissions. I think we now look in hindsight, and the reason why he was taking, you quote, such a modest amount is simply because he wasn't actually doing anything. If he would have taken 2 and 20%, this would have capsized much, much earlier, because he would have been just taking so much out of the fund. But ultimately, he became wealthy because of this. So prestige and wealth are the things that you could say the benefits while this was actually ongoing. But I don't think that actually is what, you could say motivated him to start a Ponzi scheme. I don't think, even though I think is generally regarded as kind of the number one villain when it comes to harm done in financial markets as a white collar offender, I think saying Bernie Madoff designed a Ponzi scheme and tried to create this is giving him, frankly, just far too much credit. There's no one that could have actually designed a Ponzi scheme that you could knowingly say would last decades and take in tens of billions of dollars. That's almost too brilliant of a thing to do in a sinister way. What happened here is a series of mistakes, one leading to another, that got larger and larger, and because of a combination of his unique personality, which actually allowed him to, I think, allowed people to trust him very easily. I mean, he's a cordial, friendly, very, very smart individual, which allowed people to trust him. And then a series of, in some sense, luck. When regulators looked at his business a number of times, they overlooked a number of things that could have been red flags. And then ultimately, he just was able, as he describes it, it's a comedy of errors. But what really is it's a kind of just really tragic way of seeing a person who's incredibly smart and clever, ultimately used that information and knowledge to perpetrate a really damaging Ponzi scheme that, ultimately for both friends, family, and the larger investor community has had so much harm.
Okay. So at the end of the day, how were his investors hurt or damaged by this?
Yeah, so the investors that were directly invested directly through him, and then there was another group that was invested through feeder funds, basically smaller investors that were being aggregated together through these feeder funds and then investing in him. Ultimately, when his Ponzi scheme unraveled, the question is, well, what was left? There actually wasn't that much left. There was actually, I believe, a couple $1 billion, which, yes, that's a lot of money, but that's not a lot of money considering the tens of billions of dollars that ought to have been sitting there. Ultimately, his fund was basically put in you could say, almost like a receivership, and a lawyer has basically been going after people that profited from that basically took out proceeds over time, profited from the fraud, and has been suing them to get their money back, in some sense, re-put in the hole, and to help repay investors that, in some sense, you could say lost everything. Because immediately after the fraud was revealed, the question is, was there literally anything left? People that had their life savings in some instances, some of the smaller investors, to even some of the wealthier investors that lost, we're talking millions and millions of dollars in individual accounts. So in that regard, it was pretty devastating to individuals that really trusted him as a leader in the financial markets.
So how did things come unstuck? Like, how did Bernie Madoff get caught out on all of this? Like you said, it was able to pull this off for over a decade or something like that. How was he able to do that for so long, and how did he come unstuck?
I think a series of there was a number of times in which he nearly got caught. So in 2006, actually, the Securities and Exchange Commission actually brought him in and for a deposition, because there was actually some accusations that he actually might be trading in front of some of his brokerage clients. Some people thought that one way to explain the fantastic returns of his investment management clients is that he was essentially using the data and orders from his brokerage business to allow people to front run. And that's what was producing it. So the SEC went in and basically brought him in and questioned him and looked into whether it was front running. At the end of that, they actually asked him where all the assets were being kept at this depository bank. And he actually gave them their account number. And he described how when he was coming home and he was thinking about it, he actually thought the game was up at that point in time, because he gave them the depository number, which had the regulators actually called and actually tried to verify that information. It would have been there was a problem of missing zeros. He had in the order of a couple $1 million of securities there, where one hedge fund that was invested in him should have had several $1 billion in that account. It was so wildly off. But ultimately, in that case, and regulators didn't look into that. And the interesting part is, well, the question is why, and there's been a lot of questions. A lot of people have been very, very critical that the SEC and others may have for overlooking this. At the same time, Bernie Madoff was such a well-respected individual in the financial industry that to think that this guy could have been doing a Ponzi scheme at the time, that the guy that's the chairman of one of the largest exchanges in the world was basically nothing more than a fraud, it's almost so inconceivable, so unbelievable that it's not really a plausible hypothesis. And so they were looking into front running, something that would be, you could say, he might have been doing sometimes. It could have been plausible. So they looked into a much more plausible charge. But ultimately, they didn't find any evidence of that. And as Madoff reflects, the reason they didn't find any evidence of front running is because he wasn't doing any trading at all, ironically. And but ultimately, so this is 2006. Ultimately, a couple of years goes by, and frankly, the scheme could have gone on potentially longer had it not been for the fact that as the financial crisis emerged, what happened? A lot of institutional investors, a lot of individual clients started to need to withdraw money. And so he ran into the problem of basically a cash flow issues, that he needed additional inflows, significant inflows, to maintain the amount of outflows, and reached a point where the redemptions were going to get to the level where it was just unsustainable to continue to run the Ponzi scheme. So to that point in which he, as it's described, told his sons and ultimately called regulators and quote, turned himself in for running this.
Is that really what happened? He actually turned himself in, did he?
Well, it's along with, I could say, technically I believe his sons are the ones that technically turned him in. But ultimately it was a family matter, in that he wasn't caught red-handed by an auditor or a regulator. The reason why that week or that day in particular, everything unwound is because he, along with his sons, alerted regulators to what was going on. Right.
Okay. You've spent a lot of time with Bernie Madoff in coming up with content for this book. What was he like as a person? Like, was there anything off about his personality? I mean, most of us couldn't fathom blatantly ripping off our family members and close friends and that sort of thing. For him, it seems like it wasn't really an issue.
Yeah, the first time, I remember, my first conversation, you've read so much about someone like Bernie Madoff. I mean, it couldn't, international news, for my first conversation, I mean, it was a couple years after he was convicted that I first spoke with him on the phone. This is someone that you've just read so much about that you wonder what is this guy going to be like? Is he going to be, angry? Is he going to be, reflective? What's his personality? What's kind of fascinating about Madoff is, I would say my interactions with him have been, he's cordial. He's smart as a whip. I mean, his memory, his ability to talk about detail, to go into the understanding of nuances in the financial markets, to really delve down. I mean, in many ways, I can say I think we've come to relate to each other in some ways in this academic sense that we can talk about really detailed things in the securities market. I mean, he's read papers and books that I assign to my students in class, are things that we've spent time talking about, in part because I want to see how he thinks about matters that are not around his case, but the security market more broadly. He's a smart guy, and cordial. But that's simultaneously, I know in the back of my mind, I'm entirely aware of what he's done. And frankly, he has an awareness of it, but it's in a very kind of distant sense. I mean, once he reflected that in a quite genuine way, he said, I've often wondered, I can't believe how large these losses became. Like, it's just so unbelievable. I don't know how to explain how I did this. And, is there a flaw in me? How could I have done this? And I think my time with him is in some sense been that self-questioning of trying to understand why a career which could have in many ways led to a prosperous and, career of where he would have retired as a, successful, well-respected executive, ended up now he's known as the, greatest corporate villain, and he's going to die in prison, which is something which, he doesn't express anger. I think, I think he'd be the first to say that, he deceived people. And so in some sense, the fact that he broke the law, his punishment is justified for that reason. And he doesn't hold, in some sense, a grudge, which is what also distinguishes him, that someone that's about to, be imprisoned for life and never have any of those comforts that he spent his entire life around, he's able to take that in a way that kind of take those punches in a way that is, I think, different than how most people would be doing it, which would be a form of a crisis. Which is actually, I think, deeply revealing about his personality, is how he's able to kind of confront these just radical situations with a degree of almost unusual calmness.
Yeah, it's certainly an interesting tale. Another character who's profiled in your book is Michael Rand. I'm keen to hear a little bit about his story. I think what's interesting about him is he was someone who you got to know, and he was one of the few executives persecuted from the 2008 global financial crisis. What was his story?
Yeah, Michael Rand's case is fascinating, and it's not one that made the news as much, in particular because it was post-financial crisis, and there was already so much news of trying to understand what was going on. But so Michael was the chief accounting officer at Beazer Homes, a fantastic home builder that was doing spectacularly well in a post 2000 period as there was the mortgage boom. And what Beazer did was actually build homes and housing districts. They were the type that would build, the nice homes and then build the roads in the community around these homes. Business was doing fantastically well. Actually, the problem, if anything, you could say, was they were doing so well that every single quarter they were just blasting past estimates of both analysts and their own internal estimates of how well they were doing. And that actually became a source of challenge, which is ultimately where kind of Rand's case becomes both interesting and a turn for the worse. And so in his case, when the firm was doing very, very well, one of the things they had to do was take reserves for the amount of expected expenditures to complete houses. So Beazer finishes a home, and after they sell it to the customer, there might be some additional paint work that has to be done. There might be some pipes that are leaky that need to be replaced. And so, like most firms, they would actually put a reserve associated with this additional work. And ultimately, Michael was brought in front of a judge. So, ultimately, mortgage crisis happens. Beazer, is struggling like most other home builders. And ultimately, he's indicted for what would be called cookie jar accounting. And he was being held responsible for not over-reporting earnings, as almost is invariable case, but actually under-reporting earnings. And the charge against him is saying that when Beazer was actually doing so well, that he basically instructed his executives, his subordinates, to basically over-reserve. And in over-reserving, try to actually lower earnings for the firm so they wouldn't blast past estimates as significantly as they were. And it's a pretty interesting case because I can't think of very many instances in which an executive is actually is ultimately, being in part criminally held responsible for underreporting earnings. But what makes this case even, I think, more interesting is if you actually look at how he was prosecuted, the attorney starts out the case against him saying that a accounting officer is like an umpire at a baseball game. And the umpire is supposed to call the balls and the strikes as he sees them. He's not supposed to look at the scoreboard and then decide whether it's a ball or a strike. And what the prosecutor said is that what I'm going to show you in this case is that Michael Rand was like an umpire who looked at the scoreboard and then decided whether something was a ball or strike. Now, what's interesting is to the extent people know a little bit about how accounting works, managers actually have discretion and actually have a fair amount of discretion, both under US GAAP and under IFRS. And so the case really hinged around whether he actually used discretion within a kind of appropriate guidance or or outside. And if a lot of the emails that were brought up, for example, he sent one email that was sent to the executives that said, to the executive, it said, please put all the reserves you reasonably can. This quarter is too high. Now, as prosecutors looked at it, they said, Michael Rand expressed a normative judgment. He said this quarter is too high. Therefore, anything that his executives did with the accounting estimates were fraudulent. As Mike looks at it, he looks at the emails and said, I said, take all the reserves you reasonably can. To the extent executives stayed later and found more opportunities for reserve, that's totally appropriate. And it is. That's something acceptable within the accounting system. And to the extent that he said this quarter's too high, that's simply expressing a judgment. But it's not wrong simply because you have a judgment of whether this quarter is good or bad that makes an estimate right or wrong. So it's a really fascinating case because it really challenges our notion of actually what discretion managers have when they make these estimates for quarterly or annual earnings. And that you can actually be held accountable for not just fraudulently overstating earnings, but this is a case where someone's actually being held accountable for underreporting earnings. So it's a really interesting case and one that for Rand has been significant. He actually just started serving his sentence, which will be upwards of 5 years earlier this year.
So what was his motive? Like, why did he want to underreport earnings?
Yeah, I mean, he would look at it was never underreporting. He was saying he was using his discretion to, in some sense, to use his appropriate discretion to try to slow the growth. And the reason why you'd want to, slow the growth is because if you start blasting through your earnings estimates every quarter by 30 or 40%, what's going to happen is that analysts are then going to predict next quarter you need to grow by 40%. And in some ways, at some point, you're going to create unrealistic expectations. This is interesting. If you look at Microsoft during the 90s, when Microsoft was doing extraordinarily well, if you go to the earnings conference calls, management was actually trying to walk down analysts in the investment community, telling them that they're not going to do as well next quarter as they have done in the past. It's actually what Facebook is doing right now with their mobile advertising. They're trying to tell the market they're not going to grow as quickly as they have been in the past, because the problem is you can actually build in expectations that become so ambitious or so high that you actually can't meet them. And I think that's what they were worried about at Beazer Homes, is that they were just doing so well that they were essentially making their own kind of a problem. And so what they wanted to do is essentially say, let's be as conservative as we can with our accounting. Therefore, we don't want to be pushing it in any way to be aggressive. But if anything, we want to be the other extreme. We want to be overly conservative to try to slow down this just extraordinary growth we're showing to the market.
So, I mean, it would be fair to say from what you've learned from speaking with him that he had no intent of doing wrong?
Well, I think that comes to the question. I mean, there are different ways to interpret. I bring the emails and I show students and the email that says, take all the reserves you reasonably can. This quarter is too high. And if you ask a class of people, executives, say, how many of you think that this email is intentionally manipulative? How many of you think that this is perfectly acceptable? You'll see it'll be 50-50. Half the class will say this was the intent to do wrong, but trying to be clever about it in saying he's saying it's reasonable. The other half of the class was saying he said it's reasonable. This is the kind of stuff that firms do all the time. You need to be aggressive as a corporate manager. And so to the extent that you say, it's reasonable, there's actually nothing wrong with that at all. He's not even trying to be clever in this instance. And so I think ultimately, and I think this is the challenge, talking to the executives, we can never really know exactly what their mindsets were at the time. And I don't even think they, going back, can actually know exactly what they were thinking at any point in time. What we can do is look at the evidence and what it actually presents. And I think the question that Rand's case raises is if a manager is how much discretion can a manager actually have? So a great example that he actually gave to me, but I think is an important one, is so suppose your firm is about to prepare its annual report and you have some outstanding litigation. Let's say it's whether the government regulators or maybe a private civil suit, and you need to reserve, put in an account, reserve some expected liability associated with these future payouts from this litigation. And you go to your first lawyer, and your first lawyer looks at the charges, or looks at the case, and says, "I think this is going to cost around $100 million to settle." And you go, "Wow, that's a lot. That if we actually settle for $100 million, we're not going to meet our quarterly expectations." I want to make sure that that's that's actually the correct estimate. So you go to a second lawyer who's been just as good in the past at predicting your future obligations. Another great lawyer. This lawyer says it's $50 million. And you go, wow, that's better. If we actually do $50 million, that will hit our quarterly earnings. And you go, well, let me just get a third opinion. You go to a third opinion, and the third opinion says it's $25 million. Another lawyer, well-respected, has done good for you in the past. The question is, what are you obligated to actually reserve? Are you actually obligated to reserve $100 million, $50 million, $25 million, some average of those three things? In many instances, you could actually say it's up to there's a lot of managerial discretion involved. If you actually ask a class of lawyers, they will actually say you need to reserve the amount that's reasonable. Well, the question is, you have three all reasonable lawyers, and so you can kind of pick one. If you ask a class of managers, they're going to go, we're going to pick $25 million. Well, the trick is if you pick the $25 million because you shopped around for a different estimate, you're able to meet your earnings estimates. You're going to blow through them if anything. Stock price is going to go up. But the only reason why you've managed to hit those expectations is because you shopped around for the kind of estimate that kind of works well for you in that instance. That's pure managerial discretion. That's allowed under accounting. That's not actually something we would say is manipulative. But in a way, you could say it's certainly earnings management, because you're trying to manage earnings by looking for estimates that kind of work well for you. So it's an example like that certainly shows how complex this is that what makes something fraudulent and what makes something the kind of discretion that managers get as leaders within a firm. It's not always clear cut.
Yeah, no, it definitely sounds like a very complex issue and quite a fascinating one. I mean, I had no idea that companies could use quite a bit of discretion in how they report their earnings. That's new to me. So
another interesting example is like pension assumptions. This was a wildly kind of practice that firms were employing, is that if you actually go back a decade, if you look at the rate of return that a lot of firms expected on their pensions, they were putting 8 and 9 and 10%, which I think any of us, unless you were invested in Madoff's Ponzi scheme, you weren't going to get a 9 or 10% consistent rate of return going forward. Those were really optimistic. Why? Is because they found someone to justify it. But if they would say the rate of return on their pension assets were 6%, they would have to fund them a lot more. And so it was advantageous to find someone to say that actually an 8% rate of return for your pension assets are appropriate, so you don't have to fund them as much. That helps actually maintain earnings. And we actually have some really nice academic work actually showing that firms, when they were actually having a tough quarter, they would actually meet their earnings guidance, not by cutting costs or not even by finding additional sources of revenue, but by changing their pension assumption, and by changing their pension assumption that influenced their quarterly earnings. So really subtle ways in which firms can, sometimes legally manage their earnings, in other cases illegally manipulate it.
Right. Well, Eugene, I'd like to narrow in on insider trading if we could. So I guess maybe the first question I should ask around this, and I'm pretty interested to get your take on it. What is insider trading? Like, how do the courts determine whether or not something is deemed as insider trading?
So let me focus on, I'll go according to the U.S. definition, because if we go globally, there's different definitions of illicit insider trading, but the U.S. is by and large where the vast majority, and we're talking probably 90% plus of the insider trading cases, are prosecuted in criminal. I believe actually the U.K., which would be second in insider trading charges, didn't have its first a criminal insider trading charge, I believe, till 2008. So it is really still a very much U.S. phenomenon in terms of prosecution. And in the U.S., so we can think of insider trading as any time an insider, a board member, an executive, an employee, someone with confidential insider knowledge, trades in a firm's shares. Now, a lot of insider trading is not illegal. Executives are allowed to trade in shares. Board members are allowed to trade in shares. And as long as they report those trades to regulators, that's acceptable. However, then there's another form, which is illegal insider trading. And illegal insider trading occurs when people misappropriate information from the firm and trade in it for their own personal benefit, or give someone else to trade with it for their own personal benefit. So the idea is when you're essentially stealing information from a firm, and then you're using that information in some way to benefit oneself outside that context. So let me give an example that shows how, I'll say, tricky this notion of insider trading is. And so one of my, you could say, favorite cases around insider trading, and this is a civil case about a year ago, is a couple analysts at actually Capital One, the credit card company. And these guys were basically acting like a sophisticated hedge fund trader would, that they had this hypothesis that the amount of purchases at retailers like Chipotle, McDonald's, retailers would be correlated with the sales, monthly sales, quarterly sales for the firm. So what they did was basically take the credit card database, there are two analysts inside the firm, basically come up with a very, very elaborate algorithm that would textually search the billions of credit card transactions occurring at Capital One. And they basically found that there was a significant correlation that when more people bought burritos at Chipotle, Chipotle would report better than expected same-store sales, and the stock would go up. This is the kind of sophisticated thing that goes on at hedge funds. Sophisticated textual searching to come up with a hypothesis to try to create tradable strategies. And so these couple guys came up with this and very quickly made just a tremendous amount of money, and hundreds of thousands of dollars. And ultimately, the SEC discovered this and then went after them for illegal insider trading. And the reason this was illegal is because these were two traders who misappropriated information. They took information that belonged to Capital One and then used this for their own trading purposes to personally benefit. Now, what's weird is that there would have been two ways to basically do the same exact thing that would have been legal. So Capital One could have actually hired these two guys and said, you know what? It's okay. We could use this credit card data for our own trading purposes. Can you make these trades on behalf of Capital One? If they were trading on behalf of Capital One and not themselves, it would have been acceptable. But even more extraordinarily would have been Capital One, minus whether they had an agreement with customers that might have not allowed this, but Capital One could have actually sold this data to hedge funds. And in fact, there's actually two credit card companies that actually do sell this kind of data to hedge funds. So a well-known hedge fund trader could pay Capital One $1 million to get these kind of aggregated these records of just not showing the person's name, but just showing the billions of transactions that were done and just sell it. Let's say $1 million a month to a hedge fund. And then the trader at a hedge fund could have run the exact same search these two guys did and traded on it and probably made millions of dollars. And there are ways of actually legally doing this. And that would not be illegal insider trading. That's actually fully legal. So the weird part is that prosecutors and regulators, not only in the United States but globally, often say that insider trading is illegal because it harms investors who don't have access to that information. It ultimately makes the markets unfair. And frankly, that's totally misleading, and that's actually wrong. That's not what illegal insider trading is. Illegal insider trading is misappropriating information. There's a whole lot of ways within financial markets to become appropriately more informed than other investors, using information that they can't access because it's either too expensive or they don't have, and legally trade on it. So this is what makes insider trading so interesting, is that the rhetoric about what makes it right and wrong is actually totally different than actually what the law says is right and wrong.
That's a pretty interesting case study that you bring up there about the credit card data. I mean, that sounds somewhat unethical to me, that Credit One would actually sell, was it Capital One, sorry, would actually sell credit card data to hedge funds.
Yeah, I probably should clarify. I'm very certain Capital One actually doesn't sell that data, but I will note. But I believe it's actually footnoted in my book. If some of your listeners want to look, that several companies actually do sell similar data. But we can think of a lot of other contexts. So, for example, there's a number of satellite data providers that actually sell satellite data of parking lots at well-known retailers, the Walmarts, the Costcos of the world. And using satellite data, you can see how many cars are in the parking lot to hopefully try to make better trading insights. There's companies that actually have these helicopters that go over basically oil reservoirs that actually can detect how much oil is actually in the reservoir to give a sense of how much oil is being basically sold and refined in any given month, so people can infer what oil prices will be. I mean, I can kind of give a laundry list of data sources that hedge funds, top hedge fund traders routinely use. Every top hedge fund has access to, because it's expensive data, but it's expensive data if you can afford it and get access to, that actually is extremely valuable. Now, the reason why we say that's not illegal is because hypothetically, me and you and anyone listening could go buy this data. But in fact, many of these data sources are expensive. We're talking thousands, tens of thousands, hundreds of thousands, millions of dollars in some instances. So practically speaking, they're limited to a small number of investors who can actually afford to acquire that kind of insight. But ultimately, it's not illegal because technically you're not misappropriating. You're not stealing it from anyone. You're acquiring it legitimately. But it does get on the borderline between what does it mean to act, could say fairly in financial markets. But the only reason why someone trades a share is because you believe you have an insight that someone else doesn't have. The only reason you're buying a share is because you think it's going to go up, and the only reason that person is selling it to you because presumably they think it's going to go down. So in some ways, insider trading isn't actually deceptive, because the people who are, let's say, buying shares because they have privileged inside information, they're not being deceptive. They're actually telling the people, I believe these shares are going to go up in value. The trick is that, well, how do you actually acquire that insight? Did you acquire it legitimately or illegitimately? And that's a very, very fine and delicate question, and something that's still, I think, security regulators are actually struggling. This is why we've seen a number of cases go in the United States to the Supreme Court, because it is it's a very gray area, especially when you're operating in these very aggressive kind of bounds of really unique data sources.
Now, who are the victims of insider trading? Are there victims of insider trading at all?
Yeah, this is I think the challenging part. Often, most time, people think that the victim of insider trading is the market itself. I tend to find that not especially convincing, because, as I just described, there's a lot of instances in which sophisticated investors are actually trading on information that I don't have all the time. So there's lots of instances where we have information imbalance. But what I will say, the harm of insider trading comes from misappropriating of information. If we actually think of insider trading not as someone having information that I don't have, but rather someone stealing information and then using that for their own advantage, it actually makes a lot more sense of why this is something that we could prosecute criminally and why it's actually serious. So the best instance we can actually think of this from some cases that occurred earlier in the 80s is that when people misappropriate information about a takeover or some M&A event, is that if you have some confidential information around a potential acquisition, if the firm's acquired, the stock price is going to go up. So what do you start doing? You start buying shares in the firm. And if you start buying heavily enough and you tell some buddies about it, you tell some other investors about it, what's going to happen? Those shares are going to rise in price. And what could you effectively do? You either make that acquisition more expensive, or ultimately you could make the firm price go up so much that it makes it infeasible for that actual acquisition to actually take place. So by stealing information from the firm that is thinking of doing that acquisition, you've actually harmed that firm. But that's a really subtle way of trying to interpret who's the victim. And because in some sense, in this instance, we're saying that it's the firm with information that's actually having that information stolen. One of the most interesting cases in the 1980s about insider trading is actually a reporter from the Wall Street Journal who actually wrote a well-known column called the Herd on the Street column. And he actually gave his columns and some of the information to his partner at the time, who actually would trade on it. So there's no evidence that he actually biased his column, but basically this guy would write one of the most influential columns. It was in the Wall Street Journal. It was the kind of column that would move markets. If he talked about, firm X and spoke positively of it, the firm X was going to rise the following day. And what was interesting about this case is that ultimately he was convicted criminally for insider trading. And the question was, well, what did he do wrong? He wasn't trading on this. It was actually just his column that he actually gave to someone. It was a column that he wrote himself about the firm insight that he himself believed. But what the judge ultimately explained is that he misappropriated information from the Wall Street Journal and gave it to someone. And although that's information that he wrote, this is his column belonged to the Wall Street Journal. And the only one that could do anything with that column was the Wall Street Journal. And by giving that to someone else, he could have jeopardized the reputation of the Wall Street Journal. And the only one that had the ability to jeopardize the reputation of the Wall Street Journal was the Wall Street Journal itself. And so this is just kind of shows you how people over time, insider trading has kind of evolved and changed what it means. But this case, you could say the victim was the Wall Street Journal. And the prior example I gave, the firm was the firm thinking of doing an acquisition. But it's subtle. It's not as oftentimes described simply as the quote market that's harmed, like in these instances.
Now, when we think about, I guess, when people hear about insider trading, probably one of the first things that come to mind is someone who has information who maybe can't trade it themselves, ringing someone else and letting them in on something right away before it's known to the general public, sort of giving them a head start. In those types of situations, there's two parties involved, okay? What is the incentive from the party giving out the information to do so, generally speaking?
Yeah, this is one of the questions that's been evolving about, does the person need a personal benefit? And right now, according to securities law in the United States, the person that's tipping someone off of a hint actually needs to receive something in return. Historically, that's been viewed as money. They actually get some kind of monetary compensation in return. What's interesting is the recent case, which is Rajat Gupta, the former managing director of Goldman of McKinsey and Company. I mean, one of the most kind of celebrated executives in the world. He was actually sitting on a board of Goldman Sachs, and after one Goldman Sachs meeting, he actually called a billionaire hedge fund, Raj Radnatam, and actually divulged some of the confidential information that he just learned at the Goldman Sachs board meeting soon after that call. And so the question was asked, as so regulators went after him, both civilly and criminally, for insider trading, because he tipped, exactly as your example is, he tipped off some information to this hedge fund trader. And then the question became, well, what did he receive in return? Because in this case, he didn't receive any money or a sports car or a Rolex watch or anything. But the court prosecutor successfully argued that he basically received friendship. And so this just shows you how kind of nebulous this becomes. That and he was convicted. He actually recently got out of prison. But in this case, he is appealing his case because his view that there was no personal gain from this, and if there was no personal gain, he didn't engage in insider trading. But ultimately, the jury decided that he did receive something, and that something could be fuzzy, like friendship. Just showing you how kind of diverse these benefits can be.
Just speaking in broader terms now, Eugene, your book that you've written is titled Why They Do It. So, it'd be foolish of me not to ask you, why do they do it? Like, why do people who are already wealthier than probably 99.9% of people commit financial crimes?
Yeah, so most of the time we think of the popular explanation of why successful people engage in white-collar conduct is because it's a failure of reasoning. That coming from the school of economics, this is that people, like executives, weigh the expected benefits against the expected costs, and to the extent that the benefits, could be money, could be power, exceed the cost, they go ahead. So this is a failure of reasoning. And what I argue in the book is this actually doesn't look like, in most of these instances, so much of a failure of reasoning, but rather, how I describe it, a failure of intuition. The executives themselves don't see the harm associated with these actions at the time they are actually making them. And the reason why they don't see this harm is because the harm itself is so distant. The victims themselves are psychologically and physically distant from them, and the harm itself is temporally offset. At the time they're actually doing the harmful acts, think of something like a Ponzi scheme, people are going head over heels trying to give you more money, putting you in prominent positions. It's not until later that the harm itself is actually revealed. And as a result, because there isn't not that negative feedback mechanism, like if you were to physically hurt someone, because this harm is actually so distant that intelligent, even quite smart people can actually do quite harmful things to the market and actually not viscerally see that harm at the time they are actually making it. And so that's what I explore in the course of the book, and some of the challenges that are associated with that. And at least how I kind of step back and think about that is that we all do things that we know are wrong. For example, anyone that drives, we all speed a little bit, and we find ways of rationalizing the speed limit's too low. We're not going to get a ticket if we're only going 5 miles per hour with the speed limit. We find all kinds of ways. Everyone else is going that same speed. We find all kinds of ways to rationalize why, even though we know what we're doing is wrong, it doesn't really matter. But if you want to know why people don't proceed to do things that are actually significant, is because they feel it's actually harmful. And if you actually feel something is harmful, and a particular act is harmful, you don't even consider doing it. It never even enters your decision set. And this is why, even if right now around the world in my town, we were to drop in Cambridge the prohibition against murder tonight. Police say there's no prohibition, there's no sanctions. I'm not going to be worried if I walk outside that someone's going to come up and stab me. Why? Because most well-socialized people know that stabbing someone is harmful, so it's not even going to enter their set, even if there are no sanctions associated with it. The problem with most white-collar crimes is that there isn't that visceral feeling of actually doing something harmful. And so you can actually do these really damaging things that ultimately harm investors, employees, and ultimately oneself, but not get that sense, a feeling of actually doing anything harmful at the time.
Right. So I take it you haven't seen the Purge movies?
Yeah. It's funny. I watched that just a month ago. It's an interesting hypothesis, but one that not to say I particularly want to test it, but I'm willing to say we can say that there are some countries. This is how at least I thought about it in theory. There are countries where you could say the rule of law is actually so weak in some of the securities markets, but effectively you don't see people running amok and doing everything that would be considered unethical. Countries in Western Europe, for instance, up until the late 1990s, there really wasn't any prohibition in most Western European countries against illegal insider trading, as we generally think some of the most egregious insider trading would be. And sure, there was probably some, but that wasn't what everyone was going to seeking to do in securities markets. Why? Because people had, I think, were reasonably socialized that there's more honorable ways to actually engage in trading. Much like to the Purge, I think there's more honorable ways of probably dealing with our problems than going to stab your neighbor. Fortunately.
I think that was a great analogy. I was just playing around. But one of the things I either heard you talking about this in another interview you've done, or I read it somewhere, but it was kind of getting at the point that, it's very easy for us to judge because we're not in the situation as these people who have been convicted of financial crimes. Do you think that most people in their same situation would have perhaps done the same thing?
Yes. So that's my hypothesis, that in a lot of these, maybe not all, but in a lot of these instances, we would behave similarly. And I think that's the humbling challenge which I pose to my students and to readers of this book. I mean, I think the trouble is we oftentimes think we view the world and questions and ethical decision making with our current norms and beliefs and values and incentives and pressures. But it's not the right way of thinking about how to actually resolve these issues in the context in which these executives are actually facing them. We would need to place ourselves in the position surrounded by their norms, intuitions, beliefs, pressures, culture, which is wholly different. And I think much more challenging. That if I took one thing away from this project myself, it's that to have a little bit more, I think, humility about where I think our limitations, as I described, these are failures of intuitions. These aren't necessarily failures of reasoning. And our intuitions as humans are not well designed to see these distant kinds of harms. So we're all susceptible to doing things that have these distant kinds of harms. Just we're generally not placed into the decision-making context in which if we mess up in one of these instances, it has such dramatic repercussions on other individuals as a CEO or CFO of a firm would. I mean, one of the challenges with, I'll say, corporate training or you could say business school education when it comes to thinking about ethics and thinking about these dilemmas is that we may like really easy in these kinds of training exercises that if we're going to talk about an insider trading dilemma, what do? We give you a case, which we then discuss in class or in that training exercise. And in doing so, we've actually made life really, really easy because we've identified what the ethical dilemma is. 2, we've now are talking about it in a group of different-minded individuals. And then 3, we're going to spend a while actually engaging in reasoning, maybe half an hour, maybe an hour-long discussion talking about it. In the real world, all 3 of these things don't exist in most instances. I would actually argue the hardest part for a lot of instances is actually identifying the ethical dilemma, the moral challenge in the first place. Because in a lot of instances, so I mentioned Raja Gupta earlier. Raja Gupta, 23 seconds after a Goldman Sachs board meeting, calls a hedge fund trader and divulges this information. I mean, this isn't something that you really need a case study to decide whether that's a good or bad decision. I mean, this is just a horrendously myopic and really pretty stupid decision. And I'm confident that if he would have seen this on a sheet of paper talking about it, he would have identified this and probably changed his course of action. The problem is that even someone as smart as Gupta, I mean, really a brilliant strategic mind, could overlook the most basic challenge associated with this, which is identifying the ethical dilemma in the first place. And that's something that I think executives, especially as people go up within an organization, have a more difficult time actually trying to identify which are the kinds of decisions that really could undermine me and my success in my organization, because it's very easy to believe that I know how to solve these myself, and my reasoning and intuition are going to be spot on each time, which in fact I think the evidence suggests that that's not necessarily the case. So humility is what I've taken that out, and hopefully people that read my book will gain I think a bit of that challenge, and maybe think a little bit, become a little bit more self-aware by seeing these oftentimes just really extraordinary individuals do things that had just such extraordinary and really quite tragic consequences.
Yeah, I think that's a really fair point. Now, those who are living out prison sentences, what sort of life do they lead in prison? Like, does having money afford them any luxuries, or are they mixed in with, the gangbangers and the murderers? What's life like for them in prison?
Prison, I mean, as much as it's easy to say, I think casually, because of the harm some of these individuals have done, that a couple of years in prison doesn't seem significant. I would push back on anyone who can kind of casually dismiss a couple of years in prison like that as, I think, being a little too cavalier. Prison's nasty. It's exactly, from my visits, it's exactly like one would expect. It's dirty, it's cold, and it's loud. It's just really, really unpleasant. Being privileged doesn't afford them. It affords them great lawyers to hopefully try to reduce their sentence, to hopefully try to get them out of prison in the first place. But ultimately, once they're convicted and if they're sentenced to prison, they don't get any, you could say, privileges, so to speak, that makes them really exceptional. Other than they have the resources to, call home, to write letters, to get a modest amount in their commissary account. They're fortunate; they generally have better family relationships. People will come visit them, but it's difficult. I'll say the part that I found interesting about this project is that, by and large, the executives were not remorseful. They weren't remorseful about their crimes. They recognized that they did it. They recognized that they were punished, but they didn't. The harm itself never really resonated with them. In part, as I explained, because the harm itself seems so diffuse and distant. But the thing that did weigh on these executives was the impact on their family. It's missing their son's graduation, their daughter's birthday. That's what weighed so heavily on these individuals. But the trouble is that no one thinks, I'll say, even when you're engaging in things that are clearly criminal, the kinds of things that are clearly going to potentially land you in prison, no one thinks that they're actually doing something that's going to land them in prison. People invariably see that's what those are other people that go to prison. Those are the bad guys. It's not me. That's not a position I could see myself in. And that's the problem, is that there are executives that are actually doing things that are going to land them in prison, but they can't recognize it even at the time that they're actually doing it, which makes deterrence challenging in that regard, is because you want people to think about, oh my God, if I do this, I'm going to miss I could miss my daughter's wedding. I could miss my son's graduation, because that would deeply impact, I think, decision making. The trouble is, while these decisions are going on, people are not thinking that.
Mm. Do you feel as though those who you've documented in your book, do you feel as though most of them were fairly prosecuted, or do you think some of the punishments were too harsh?
That's an interesting question. I've thought about that in some instances, where it depends how you want to, I think, look at it. I think by and large they're fair, because the impact of their decisions are really quite extraordinary. At the same time, I'll say, from the standpoint, if we're thinking from deterrence or even the impact on their lives, whether someone's in prison for 5 years or in 1 year, it almost is serving the same in some sense effect of what it's doing. Their ability to actually go back into business in the future is eliminated. Their reputation is gone. The only thing that really, in some sense, impacts by, in some instances, being in prison for 3 years as opposed to 1 is what they're missing out. Which, from my standpoint, missing out on more events in life, their time from their kids and their spouse, it would be, if that was serving a strong deterrent effect, I would actually be, I think, in favor of that. The trouble is, I don't think that's actually serving a strong deterrent effect. As a result, I actually don't know if a lot of the effort which has been created to lengthen sentences is actually serving the objective in which regulators oftentimes have kind of spelled out of why we ought to send to prison people as long as they do. I mean, many instances where I do think the sentences are pretty extraordinary, which I don't know if it's speaking about the white-collar crimes are too long or murder or manslaughter is too short. But a lot of these instances, I mean, we look at sentences like Madoff or even some of the CEO of Enron, they're in prison for longer than people who actually commit certain types of murder, certainly longer than manslaughter, but even people with, second-degree charges. It's pretty extraordinary to think that you could actually be a CEO and engage in a white-collar crime and actually be in prison for longer than someone who killed someone. That I think that's pretty humbling to think that. I think that actually, in one hand, recognizes that regulators think that is that serious, which it perhaps is. On the other hand, it actually suggests that in my view, that maybe people who convict some of these violent offenses, maybe they need to be in prison longer also. It's a challenging question, but these things are, I think, always kind of changing over time. And judges, the one thing I have been happy is that judges have been using a lot more of their, I think, own individual discretion to find out what's the appropriate sentence for individuals, rather than just relying on sentencing guidelines, which oftentimes produce just really odd and really just extraordinary sentences because it's based upon dollar losses rather than the underlying crime itself. Where really people should be punished for the underlying crime, not the dollar, so to speak, because that's in some ways unrelated. If you're a bigger firm and you commit fraud, that's simply going to have a bigger dollar amount associated with it. But that doesn't make that offense actually any worse or better than someone from just a relatively smaller firm that did the exact same offense.
That's a really fair comment. I think you answered that really well. Now, there's one other thing I'd like to ask you about, and then we'll probably call this a wrap. But I guess this probably comes under the category of financial crimes. And I'm not sure how closely you've been following this case, but Nav, the trader who's allegedly responsible for the flash crash, I don't think he's been sentenced just yet. But the latest thing I read is he's expected to serve about 6 years in prison. What are your thoughts on that?
Yeah, I'll say I don't know all the details of his case, so I probably I don't want to unfairly judge without knowing all the details. But I'll say the flash trading is actually pretty interesting in that, going back to our discussion around insider trading earlier, is that there's just a lot of, I think, opportunities in which people are trading on information or trading in ways that we would, if we step back, are saying that would be potentially unfair. A lot of these things are you could say, allowed, or in some cases, it just simply haven't been deeply investigated or people are willing to overlook. So a lot of these kind of cases that pop in the news, for example, of this one, it makes me question if we were to step back and rather than having a specific individual, we could say the same thing with the LIBOR case, Tom Hayes in the UK. We have these individuals that become almost figureheads for these offenses, which really represent a much broader, I'll say, cultural and institutional problems that, frankly, a lot of other people are doing things that are similar, but are, for whatever reason, not being punished in the same way. And I think this goes back to what ideally would rather do is, rather than trying to find an individual, is actually think about, well, what institutionally is causing some of these things to arise, and then figure out how to, I think, fairly met out sanctions against all the people that are actually involved in this, rather than a single figurehead. But that's challenging. That requires many more resources. And I think the one area where I'm pretty sympathetic to regulators is that they're under limited resources. So what they have the incentive and frankly they're forced to do is not go after all the instances they see, but go after the ones where they have a great case and can create the really convincing evidence to make the conviction. And it's though that particular or 2 or 3 individuals that end up being sanctioned, rather than kind of all the individuals that are much more genuinely involved in that type of misconduct.
Eugene, let's leave it at that, man. Guys listening to this podcast, if you want to grab a copy of Eugene's book or just find out more about it, you can go to chatwithtraders.com/whytheydoit, all one word, no dashes, and that'll take you directly to Eugene's book, Why They Do It, on Amazon. So that's chatwithtraders.com/whytheydoit. Eugene, where else can listeners go to find out more about you?
Well, on my webpage, I describe a little bit more of some of my academic work related to this. And slowly but surely, I'm a social media, I'll say, amateur. But I've been slowly tweeting, slowly but surely, about some of the interesting in unusual cases that I do see pop up every once in a while. So trying to highlight, I think, some of these interesting issues that we've been discussing today in some of the work.
A good one. So do you want to give out the link for your website and also your Twitter handle?
Yes. So it's at Eugene Soltes, and then my website, it's at Harvard Business School. So it's either accessible via hbs.edu, and you'll see me pop up Eugene Soltes. And I also have eugenesoltes.com, describes a little bit more and also gives an excerpt, the first chapter of the book if people want to read that.
Oh, very cool. Well, I'll make sure to include all those links in the show notes as per usual. Eugene, thanks very much for doing the podcast, man. This was a lot of fun.
Thanks so much, Aaron. I really enjoyed it.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.